All right, good morning, everybody. Hope y'all are having a good weekend. Back to the grind, right? But yeah, as always, again, I hope you guys have had a good weekend so far. This next week that we're going into is going to be pretty interesting. February is generally a much better month than January. If you guys struggled this last month, I mean, a lot of the things that we talked about, pretty much everything we talked about, higher time frame wise, did deliver. It did do pretty much what we talked about. The delivery wise, there was off and on decent price delivery. But again, if you struggled at all this month, don't beat yourself up too much because January is generally a harder month. Same with December, sometimes November. In the summer months, like in June, July ish, sometimes even August, things can be a little bit more difficult. It's just because of the seasonal tendencies and what's happening overall around those times in real life. And so, yeah, just note those times of the year down and just cater your risk management plans around those times as well. So like if you know that we're going into a month that has a somewhat more difficult seasonal influence, you should know that, okay, I'm going to drop my risk a little bit, right? Or limit myself. Regardless, if you're spending any time here and you take what I say and you apply it, and you find value in the stuff that we talk about here, you want to never overtrade anyways. Our limits to trading is 1 to 2 trades a day max. On days that are higher risk, or months that are higher risk, we only trade 1 trade a day. Risk management wise, in terms of the normal plan, depending on your risk tolerance, you want to have anywhere from 0.5% to 1%. If you are not consistent, you should have less than 0.5%. With that set aside, when you take a trade and you lose a trade, your next goal is to mitigate the loss. It's not to make a ton of money. It's not to pass a funded challenge because you took a loss. You have to drop your risk by half. So if you have 0.5% risk, like initially, like that's where you have decided, that's where your comfort level's at. Then if you take a loss, your next trade should be 0.5%. So 0.25%, right? And then you leave it there until you make back what you just lost. And if you continue to go into drawdown, if you take more than 1 to 2 or 2 to 3 losses in a week early on, consider pausing and just giving yourself a break. Because clearly, if you take multiple losses at the very start of the week, you're going to want to see what's going on. You don't want to just keep pushing and pushing and pushing and pushing and make the bleeding even worse. You got to reevaluate when you start seeing that things you're trying to see in price are just not coming to fruition. This mindset and this protocol is called a regressive risk plan, right? Or protocol, whatever you want to call it. It's a regressive risk plan, meaning that when you take a loss, you're dropping your risk. So when your equity curve's going up and it takes a dip, it's not a sharp, like ridiculous roller coaster ride. It's a slow progression, right? It goes up and down a little bit and then up. Maybe you take 2 losses, but since you dropped your risk, it's not going to be like you were risking 1% or doubling your percentage to try to make it back. Because when you do that, that's when that's when your equity curve is wild. And that's not what you want. Professionals have a slow stair climb with losses anticipated. And when those losses do come, if you operate in this way, things are a whole lot easier mentally. Everybody goes through losing streaks, and the question is, how are you going to manage those losing streaks? How are you going to respond to when price does not go your way? That will make or break you as a trader. So definitely something to keep in mind. It's one of the pillars to what we do here, and honestly, it's one of the pillars in terms of what ICT teaches. because he even says himself that we are not, as a trader, our title is trader, but at the same time, at the end of the day, what are we really doing? We're managing risk in a portfolio with capital. So you have to realize that managing risk is your number one priority, not making money, trading well and managing risk, following your rules, being disciplined. Those things are more important than thinking solely about the money, because you do those things right, money's a byproduct. There's no guarantees, obviously, but if you do things properly and you operate in a professional, responsible manner, people like Tony see in the chat, he sees that, things change, and getting organized with your different processes, from bias to targeting to validation and validation, and everything in between. You start to see some really, really nice results. Doesn't mean you're going to get rich tomorrow, but we want to get rich almost for sure, right? So that takes time, and you got to be disciplined, and you have to really, really solidify the things that you're doing and make sure that the downside is accounted for, because it always comes. You'll have losing streaks. Everybody has losing streaks. The best traders that you guys, maybe try to pay attention to, even ICT, they take losses. What's the difference between them and someone that just blows their account? Risk management. How they deal with those losses, the conversation that they have with themselves, what they tell themselves, and stuff like that through those harder times. You can't enjoy the upside if you're not willing to figure out how to manage the downside, because the downside comes, and you can't just play offense. You have to have a good defense, and a good defense requires risk understanding, how to manage the downside, and experience applying those specific principles. So you can build the trust behind what it is that you do. Especially, again, if you want to be a full-time trader. Because downside, if you have to pay your bills next week, just imagine. I've talked about this on the last call. It's a different world from trading full-time to just, dibble and dabbling here and there. So this is one of those elements that has to be in place. We had this small conversation about this in the last call, so I won't go too deep into it this time, unless you guys have specific questions about that topic. But yeah, take that and do what you will with it. Very, very important. But yes, last week was life-changing. One mistake because of my patience, but things are getting much better and my awareness is growing. Everything you marked played out. I'm glad that you've seen that, Tony. I'm telling you, it pays attention to be around people that know what they're doing. And following doesn't always dictate whether that person knows what they're doing or not. The channel here is small, but the results are big. They're massive. And you're one of many, and I'm grateful that you take the things that we talk about and have applied them and are already starting to see changes, brother. It just goes back to what I was just mentioning. This stuff can really change things. And it's just a shift in perspective, a shift in the way that you operate, so. But yeah, Tony, as we go through this overview, and anybody else that hops on, if you guys have any questions, let me know in the chat, and we will get to those in a little bit. But yeah, like I mentioned, next week is going to be pretty interesting. We're going into the end of the month. So like I talked about in the other call last week, the end of the month, the end of the year, the end of the week, for the most part, can lead you to times where price may be a little disjointed. It may lead to more sloppy price delivery. But again, you gotta account for those times as well. And that just means going back to the risk that we just talked about, the risk protocols. You want to consider dropping your risk, have less volume, in anticipation for a better condition. February should be a lot nicer than what this month presented. Again, there have been nice moves. Like Tony said, everything we called out, everything we identified, every scenario, for the most part, played out. That doesn't mean that, just because we got bias correct, it doesn't mean that the delivery on the lower time frame was adequate enough for you personally to enter and find your model. But overall, right, being in line with the higher time frame will lead you to better results, which is why we focus on this so heavily every week. And live trading calls are going to take place in February. So I hope to see y'all here for that as well. So you get to see kind of the moment to moment dialogue and process on the intraday charts more than just the higher time frame. And the reason why I start these on the higher time frame for these weekly calls, and I don't even drop down to the lower time frame, that's done on purpose. I could easily go to the 15-minute. We could discuss that for whatever reason. But the point of making you focus on that higher time frame is to make you realize just how important it is. Tony saw that last week, and I'm sure for the last couple weeks and maybe months since he's been here, he's been able to see the higher time frame be in line more than it hasn't. And when you're in line with the overall view of things, when you go to the lower time frame, you won't be faked out by a higher time frame bullish trend that ends up reversing. You won't push a sell if you know that maybe we're just in a retracement reaching for maybe a bullish order block below us, or a bullish fair value gap, or a previous week's low. And then maybe once it hits that, it'll go back in that higher time frame direction. You won't be comfortable with navigating that unless you really take to heart how important the higher time frame is. So that's why the focus on these calls is generally the higher time frame, and I don't bother even pulling your attention to those lower time frame charts when the week starts, for that exact reason. You need to focus on the higher time frame. ICT has said multiple times, when he had the question asked to him multiple times, what is the time frame you spend most time on, right? Where do you spend the most time? And he specifically said on multiple occasions, on multiple videos, in multiple series, that the higher time frame is where he spends the most time. You wonder how he's in line with the market more often than he's not. That's your answer. That's the answer to that question. You spend more time on the higher time frame, because when you're in line with that higher time frame view and you understand how to navigate that, when you drop down to the lower time frame, it's a totally different world. A lot less fake outs, especially if you understand Power 3. You incorporate that with your understanding of the higher time frame, which again is what we discuss on a weekly basis, and narrative identification. You focus there, and things, I'm telling you, it just becomes a lot less stressful, a lot more reliable in terms of where price is going to go. I did mention very continuous liquidity pools that we have access to, which I can also go into if you guys didn't write that down or screenshot what I mentioned last week in the last couple videos. But yeah, do you guys have any questions so far? If not, we will speed on past this. Just let me know in the chat. But we have a FOMC statement next week. We have federal fund rate conversations. It's probably going to stay unchanged from what I've been hearing. So, this is impactful because we always talk about the interest rate markets, and this is one of those red folders that can play as a wild card. It may do whatever the hell it wants, depending on what they choose to do with the federal funds or the interest rates. And then, of course, that's coupled with the FOMC on the same day. So it's going to be real hectic. And at the same time, the day before or a couple days before these types of news events take place, sometimes they're good. Sometimes they set things up liquidity-wise in order to blast through whatever liquidity was left on the day that these news events come out. So keep that in mind as you go into next week and operate. Adjust your risk in a way that we just talked about. Make sure you have a lower frequency. Cut your risk by half if you can. Again, having max risk in a highly volatile, likely to be crazy style market doesn't get you to your goals faster. Matter of fact, it will speed you to blowing your account. Okay, especially if you don't have things in alignment and have the experience to navigate more volatile environments, like federal fund rate, for example, or FOMC or NFP. So get peace from understanding that going into these types of environments, just observing them is going to do you a whole lot of good, rather than going in there and throwing spaghetti at a wall, right? Just pushing execute every 5 minutes just to make sure you don't miss a setup. Not having that mindset will serve you well. Realize that this stuff can be a little crazy on these times. It's not impossible, obviously, But if you don't have all these different elements to your trading understood, from risk to bias and validation, invalidation, if you don't have all those different things solidified, you want to make sure that you are very cautious when these types of news events take place. Okay, so yeah, that is the landscape for the coming week. We're going to keep an eye on Monday and Tuesday. We're going to be very cautious on Wednesday. Depending on what happens, we'll make a determination as far as whether there is any type of engagements to take place on. And then depending on thumbs off of the federal fund rate and the FOMC conversation, that will dictate what the Thursday and Friday will do. We got a decent amount of red folders, so that may lead us to some volatility that's tradable. But again, we're just going to have to see what takes place. So yeah, going from there to our first endeavors, as always, we have the bond market, right? Again, just to review the impact that this has. This generally influences where the currencies are going to go, foreign currencies and the indices, right? So if this is going lower, generally it'll yank the indices or influence the indices and the foreign currencies to have an interest to go lower. And if we can find justification in those assets for lower prices while we see the bonds going lower, then obviously we may have to consider targeting discount arrays, right? Because again, if you guys watch this impact and have been here for a while, or go back and look at some of the other assumptions we have made, and then see how the bond market influences the currencies and the indices plus the DXY in a reverse capacity, you see why we talk about this so often, right? And we'll get too much into that. We do every week, but yeah, just understand that, right? So price basically took out buy side here, ended up dropping lower, right? A shifted market structure here after taking buy stops, and then ended up retracing, hit this fair value gap, and then delivered lower. You can see how on all three of these, we have the 30-year bond market, 10-year bond market, and then the 5-year, right? So what we like to do by having all three of these is observe SMT and see if we could see that in some capacity. Generally, if you could see that in some capacity going into a new quarter, going into a new month, things like that, you can also use that in conjunction with COT, which we're going to discuss again in February when the new month starts. But if you can merge those together, a lot of times you can get in front of quarterly shifts as well. And then, of course, that's aside from adding on the indices analysis, the DXY, and some of the currencies as well. This alone, being able to identify SMT across the bond markets in some capacity, in conjunction with the COT, again, that can lead you to a significant signal as far as will price turn around, right? If it's logical, right? Like if this left SMT at the highs here, and then of course broke down and COT showed bearishness for the bonds, then obviously that'd be a pretty significant tool. Sometimes obviously it doesn't show up, right? If we drop down, I'm sure we could probably find some type of SMT in there. Just not on this time frame. But nonetheless, I hope that makes sense. So yeah, I'm assuming, right, we're going to continue to press lower here. Some of the levels that we have a weekly fair value gap in here. But aside from that, if we want to stick to this monthly view and just get a feel for, here, let's actually start completely fresh. Whoops. Right, so like I mentioned, price ended up using this as a retracement to then give a drop. We have, here actually, let me put a label on this monthly fair value gap. Right, so you're probably wondering why, if you haven't heard ICT talk about the volume imbalances and the fair value gap, when you have those things right next to each other, you have to incorporate the volume imbalance as well. Because if you don't, you're going to miss the precision. Because a lot of times if there's this type of scenario when they're both coupled together, it's going to use that entire range. All right, or that entire range is going to be something you want to observe from the fair value gap that's coupled with the volume imbalance. So you take the upper portion, in this case, of that volume imbalance down to the low of the fair value gap. And you can get a range that will be pretty dynamic if price wants to use those levels. Right, so keeping that in mind, let's put it across the board. See what information we can pull from all three of them. If there's any differences. So we could see that the 10-year has a little different response. It's a little bit less powerful through that level, right? So again, we have broken through it, but look how we closed right back above it again, right inside of it. So again, we're going to want to monitor the response here. This monthly inversion level could play a significant role in terms of validating resistance to push us lower and to continue to trust downside objectives, at least from this monthly time frame perspective. All right, so we're going to keep that. So this and the low down here is probably, and then this wick too is probably going to be the only things that I'm going to try to really highlight on this time frame. Right, and then if we look at this one, we have a very similar response. So yeah, and let's take monthly low. All right, so let's mark that as the monthly low. Right, then we can mark off the current monthly high as well. We talked about this on the other call and the last couple calls. When you're worried about, not worried about, but when you're trying to focus or narrow your focus on what's important, you want to figure out, last week we pointed out the weekly highs and weekly lows, right? And then that gave us a range, a current range, a more current liquidity identification process in terms of what's important, what's near the high of the previous. Can you guys tell me if everything's clear in terms of the picture and the volume? Showing on my end. Just let me know in the chat real quick. Just let me know in the chat how the quality is real quick. On my end, it's kind of showing there may be a problem. It's clear. Is there any laggy vibes in terms of like the picture when I pull it around? Sorry, I just want to make sure that you guys are able to see. We're going to talk about important stuff. It's clear? All right, beautiful. Thank you guys for letting me know. I appreciate it. If there is any issues that take place, just hit me in the chat just so I'm aware. I don't want you guys to have to deal with some BS quality. It's a little laggy. Video. Oh, okay. Okay, you're talking about like, okay, I know what you're talking about. All right, appreciate you guys. But yeah, so this will be pretty much what we're going to observe on this time frame. If you look at the monthly time frame, it's very easy to think, oh, well, is this important? Oh, well, is this low important? But again, to narrow your focus so you're able to zone in on what's truly important at the moment for the next week. And then, even for like the day-to-day price delivery, we want to have this type of process. We looked at where price did come from. I marked this just to make an example of, what took place. But again, we don't really need that because it's really far away. We have the monthly high and monthly low. Those are the two most important things in terms of what's near term, but obviously still a bit far away, right? So We don't have really any SMT that we can see in terms of these highs. So we just see that prices basically came back down into the range here. So we're going to have to keep that in mind as well. We do have this low here. This low may, price may want to trade a little bit back. We don't want to stay above that for too long if it does choose to run backwards. Seems as though this month, because this is the monthly chart, this month is going to end in a indecision candle. So that's something to keep in mind. I mean, that just even highlights the fact that, if you have struggled a little bit, that plays a role, and just keep that in mind when you do your journaling. Note that down for next year. So when you go into January, you can revert back to, what this January did next year. And then you can kind of couple that with seasonality. And then over the years, you can start building a narrative as far as what to expect as the months occur. You can already have like a rough estimate of what price has done in the past. And then, of course, seasonality and the impacts that has on price. But yeah, so this will be what we're going to look at here. So let's actually drop down to the weekly time frame. Right, so we have this higher time frame monthly fair value gap that, if price does want to come back into it, we want to observe the response from there. Right, but we now have a little bit more of a refined area to look at. Right, so now more current price delivery and liquidity to look at would be here at this previous week's high and then the previous week's low. Because if it is going to target a monthly high or a monthly low, you can now start to see as we zoom in, we start to get closer and closer and closer to things that are more near term in terms of importance when we're looking at different liquidity identification and range navigation, right? Like, and answering the question, what is important right now? Do I have to worry about this high? Do I have to worry about this high, this upper fair value gap that's like light years away relating to, what we're dealing with right now? No. What's important for me going into the next week? Well, that's going to be sometimes previous month's high and low, depending on if we're close to it when the new week starts, which in this case, we're really not. Then you move down, right? One more layer, and you have the weekly high, right? Previous week's high and the previous week's low, right? So now we get even more near-term liquidity read on, or as far as what we should be focusing on going into the new week, right? So if this next week is going to be bullish, the two extremes in terms of what we see in price right now would be the weekly high and the monthly high. Whoops, sorry, I didn't label that right. Right, so if this next week or even the next couple weeks is going to go higher, before we get to like a fair value gap like this one, which could be the case, we just have to wait and see, right? But if that's going to take place, if that is eventually going to be targeted, before we get there, we have liquidity to target on the way there. And then this same process continues as we go lower in time frames. So this aspect of liquidity navigation and just price navigation in general and labeling as far as what's important, this is extremely, extremely helpful to many, many students. I know it was important to me, or it was very helpful to me when I was figuring out like, okay, what do I focus on? There's all these different PD arrays. There's all these different highs and lows. What should I narrow my focus on today or this week? And this is how you answer that question. You get these types of areas identified and, the different PD arrays that are in close proximity to these levels. And then as price prints throughout the week, in the coming week, you're able to keep this stuff in mind and not lose focus as far as what is important. Like what is the more likely area of liquidity that could be targeted on whatever specific day you look to trade, right? So yeah, if price is going to go higher and reach for something up here, it's going to have to breach through the previous week's high. If it's going to go lower for the next week and it's not going to stay consolidated, which could also be the case, then it has to blow out the low down here, right? before it gets down to something like, the monthly low or this low, So depending on what it wants to do, how price opens up, right, we're going to have to see. So far, it seems as though, we're probably going to continue to go lower. So we're going to want to have to see if things continue, right? We have this large wick here that also plays a role. It seems as though this midpoint has been respected, right? You could see a pretty decent response on this as well, right? This fair value gap, we came right back into that, but we gave a wick, right? So an indecision candle was made for last week, right? So one more thing to mention about the relationship between the bonds and yields and how that impacts the DXY and the currencies and the indices. When you see the interest rate markets not doing anything or overlapping in terms of, higher time frame candles or giving indecision candles or just, consolidating in a range between the bonds and yields, that is going to send reverberations through the other markets. It's going to make them less reliable in terms of delivery. Okay, it's going to make them more choppy. It could lead to consolidation and price not wanting to be one-sided and just going back and forth, right? So the fact that we see the overlapping behavior here just adds on to the understanding as far as why January, for some people, was a bit difficult to read, or if you struggled, and you couldn't, you figured out where price was going to go potentially, but it just didn't deliver in a clean manner. This highlights the reason why. Okay, so keep that in mind. It's a very, very important aspect of things, and just again highlights exactly why this asset class is so important. All right, so yeah, I hope this makes sense in terms of the liquidity or the PD arrays that are close to us. We have again this high up here, we have the fair value gap here, and we have this as a bullish order block if price was to close above it. We have not got there yet. If we look at the 10-year here, we see the response and the wick behavior inside this monthly fair value gap transposed to this weekly time frame. So you can also see the importance of the higher time frame levels as we transpose down to the lower time frame levels, just how important and impactful those levels are, and why you need to focus on the higher time frame too. There's a lot of people on the internet that claim with large followings that the higher time frame doesn't matter. And they're dumbasses. Okay, don't listen to those people. I'm not the only one that says that too. It's ICT saying that. It's many of these other really high-level ICT traders. Don't listen to idiotic nonsense like that because it's not worth it. You can clearly see evidence here shitting on their argument. Just because they want to navigate the 1 minute time frame to try to sell people signals and act like they trade every 5 seconds doesn't mean that they have any validity to anything that they say. Most of the time they're lying anyway, like we talked about in the other calls, right? So yeah, that's something to keep in mind. But as far as other levels, again, we have this wick. We want to make sure that we keep that in mind and see how the behavior is around that wick. If we do blow through this high here, measuring out this wick, breaking it down into quadrants, we also have the upper quadrant, the 75% level, that can also be targeted in conjunction with obviously this monthly high that we highlighted on the monthly chart, and then this high here going into this fair value gap if it was to reach up and try to do that. But again, we're too far away from that to assume just yet. We are overlapping candles. We have indecision candles. So again, we want to just be able to get more evidence as far as what side can be more trusted. If we're taking this higher time frame direction into account, clearly it's been very bearish. So unless something dramatic changes, aka 3 PD arrays breaking to the upside on this time frame, you could use this time frame as your point of validation. If we see this order block hold, if we see this high break, if we see this fair value gap break, if we see none of these levels above us rejecting price at all, and we just start to fly, then obviously there it is, right? That's going to help you identify exactly what price is doing at that moment, and then you use in conjunction COT and the other things that we talk about to also further validate whether that change in the overall state of delivery is going to be valid. If we break above this high, this order block, after taking sell side and we start rapidly attacking buy side, this can also be considered as a potential balanced price range. That's what a order block is, right? That's what ICT says. People don't understand what an order block really is. Well, there's your answer, right? It's a balanced price range. That's why the midpoint should be respected. That's why the upper portion, the high, should be the most sensitive. And the deeper it pulls into that order block, the less valid it is, because then this does not represent a balanced price range if it violates the midpoint of the order block 50% level. And that's the same with a balanced price range, right? I got a video coming out soon about that as well. But if you bust through the 50% level of a balanced price range or a assumed balanced price range, then obviously, it's less trustworthy, and most of the times that invalidates the particular direction price is going if it does turn on that balanced price range. Reaper Trader, yes, and you sound like you're about to be a hater, and that's okay. God bless you, brother, and I wish you nothing but the best. But yeah, so that's pretty much all it is that we're going to focus on in this time frame. So let's actually drop down to the daily real quick. So yeah, so keep these levels in mind that we just discussed. All right, we got a volume imbalance in here. We have a new week opening gap here. That's what all these gray levels are. All these gray levels are separations between weeks. So this indicator, if you guys don't know, is right here, the weekend Saturday, Sunday indicator. Right, so all these indicators have nothing to do with taking an entry, right? Most traders that use indicators to take entries are dumbasses. And generally, they find out real quick that it doesn't work. Indicators don't dictate where price goes, and it is what it is, right? You can make the argument otherwise, but let me see your stats, right? Because that'll basically tell you the validity to whether that indicator is telling you what to do or not, or if you're just getting lucky. But yeah, so these indicators are the ones that I recommend you focus on, right? ICT Everything one by Cold Brew. He's an amazing individual. Nephew Sam is also an amazing individual. I met them personally on Twitter, X, whatever the hell you want to call it. Their indicator with the fractals is important because the 5-bar fractal pattern, you're showing up to the party late. Fractals also, actual, like real fractals, generally dictate the measurement and the range. Right, if you're trying to place a fib, if you place it at the wrong fractal, you're going to get the wrong measurement. You know, it assists you in actual structure that is important. And I got a video about that coming out as well for the fractal nature and price, kind of discussing the navigation from higher time frame to lower time frame, how the higher time frame impacts the lower, and then the fractal pattern itself and how that can help assist you with bias and narrative, which we're going to talk about that a little bit when we get into the indices. But yeah, you don't really need this one unless you want it aesthetically. Ideally, you want to have this ICT Everything one, the fractals by Nephew Sam, so you can put the 3-bar. Okay, and then the weekend day separator. Like I said, it helps you identify the Sundays, which consolidates your thinking. So then you can observe the new week opening gaps and just a weekly range as a whole. But yeah, so we have this fair value gap in here. Again, ICT says specifically that when you have a volume imbalance, you got to use the volume imbalance with the fair value gap to get a more accurate measurement, because it does consider the volume imbalances when it has the pair like this, right? So I'm going to keep that in mind as well. Let me mark that. All right, so we have this shift in market structure. There's a run on stops. Obviously, prices aggressively smash to the buy side. This shift in market structure, in my opinion, will only be trusted if this fair value gap wants to hold price, right? Because if you consider what I mentioned earlier with the three PDA rule. If we break three PDA rays to the upside or three PDA rays to the downside, generally price is going to commit to that direction. In this case, right, there is a likelihood that we could continue to reach higher. Remember what we talked about here, right, on these upper time frames, the weekly and monthly. There is an argument for price to do that and still not fully invalidate the downside objective. But again, if this high was to be violated, do you see any swing highs getting violated in this run lower on this higher time frame weekly chart? Right? When a fractal high or multiple PD arrays were violated to the upside in a run higher, like in this example here, what happened? Right? After it was dropping, it started violating things, multiple PD arrays, three PD arrays to the upside and fractal highs. So what happened? Price turned around and started reaching for buy side. So we take that same principle and we drop that down to where we're at currently, and we can continue to observe that as well. If price was to attempt to break this high here, we'd have to see the delivery above that. Bias does not change, or narrative doesn't change on a day-to-day basis when it comes to overall direction. Bias can change, right? There can be a bearish bias and a bullish trend on the higher time frame. That's a retracement, right? And vice versa for the opposing side as well, right? So you want to keep tabs on what dramatically changes in price. There has to be significant changes for you to overall disregard the narrative that you're operating within on that higher time frame, right? So keep that in mind. It's very important. And those of you that have been whipsawed back and forth trying to buy and sell and having a hard time figuring out what direction price is going in, if you take this into consideration, you'll see that you don't have to be running yourself through a wall and you could trust one side until things change. The things that change is three PD arrays to the upside, three PD arrays to the downside relative to the time frame you're looking at. And if you're anchoring your bias and narrative from the higher time frame, as we discuss all the time, then again, it takes a while for things to shift overall, for you to start committing, for example, from a downtrend to an uptrend, right? This downtrend can obviously have retracements, right? You can adjust and start to buy inside those retracements, in this case, because we're bearish, right? But you just have to keep in mind so you don't get fooled when it does decide to go back in the direction of that higher time frame, right? There is this run down below this low here. So this retracement is permitted, and the buy side targets or levels to watch for a response pushing us back to the downside are as follows, right? It's this wick, the midpoint, the quadrants, the fair value gap up here. Ideally, we don't want to see that go back into there. We want to see very little run to the buy side. It could do that, maybe wick above these stops here, then continue to drop. If it does that, the only way that I get back in line with price going lower again is if it breaks back below this fair value gap here, uses maybe this monthly fair value gap also as a rejection level to push lower, and then ultimately breaking through the midpoint of this order block here. That would validate my assumption that price is going to then attack the low here and then possibly even eventually get down below here if it got excited enough to do so, right? So for now, using that information, right, that logic, we are going to trust the fact that the downtrend has not fully stopped. We're going to allocate adjustments and flexibility for price to maybe want to attempt one more time, but ideally we don't want to see that, right? We want to see it continue to leave highs like this available and just continue to march lower. Again, if that doesn't take place, if we break above or stay above this daily fair value gap area here, and it uses this as support, then obviously we can make an argument, half risk, because we're not fully adjusted yet from bearish to bullish. If we're looking to buy, or we'll drop the risk by half and then try to target until something confirms going to the downside. And then maybe it doesn't confirm, but we've already made the adjustment and have these things in mind to be able to safely and accurately adjust to buy side delivery off this large downtrend. Does all that stuff make sense, you guys? Let me know in the chat. And then we'll move on. Because in my opinion, this is pretty much all we really need to pay attention to here, again, we do have this new week opening gap, right? So you want to keep that in mind as well. All right, appreciate you, SD. Appreciate you. All right, cool. But yeah, so this is fairly, straightforward. It's not a bunch of rocket science. It doesn't have to be, right? If you go on my Instagram and you go see the most recent post I made, ICT a lot of times makes things complicated for no reason. Well, no, it's for a good reason, right? It's because he doesn't want dumbasses copying his shit, acting like they created it, and then coming out and trying to, make their own brand, stealing his information without giving him credit. And, there's easy ways to see things. And that just validates the simplicity in the way that we operate, right? And it validates the topic of keeping things simple. It doesn't have to be rocket science. You can focus on one model. You can focus on organized processes and not have to be a insane genius, right? Like it's very straightforward stuff. But you have to have a pretty good understanding of the complexities to things in order to simplify stuff in a more, less demanding manner. It takes longer for me to explain the things that I'm doing than it does for me to apply them. And it's going to be the same for you. Once you understand the dynamics in the different elements, it takes you maybe 10, 15 minutes to figure out what the hell price is going to do, right? Or where it could reach for, where it probably won't reach for, and then, make adjustments along the way. All right, so, all right, cool. Everything makes sense. So these are pretty much the levels that I'm going to keep tabs on. Again, I'm going to keep this off. I have it written down on a piece of paper, the new week opening gap level here and here. We have multiple new week opening gaps in here. Again, we were on that weekly chart. We see how things are kind of overlapping, kind of stalled out at this point. It's reasonable knowing that we're going into the end of the month, knowing that we're ahead of a thing like FOMC statements and the federal fund rate. So keep that stuff in mind. Don't have too crazy expectations going into the new week. So yeah, let me make sure I have all the. Let me get all the assets for us. All right, cool. All right, so now we'll move on to the yields. Again, for those of you that haven't been here before or just checking in on the things that we do here, just to review real quick, the bonds, the last market we were looking at dictates where or influences the currencies, and the indexes, the indices, and the yields, which we're going to talk about here, generally influence where the DXY is going to go. So being able to merge these relationships together and understand what these are doing and what they could do or shouldn't do before we move on to the DXY, before we move on to the indices, if they have a heavy back-end impact as far as what those other assets are going to do, you can see the value in understanding what these assets are going to potentially do. And again, those of you that have spent time here for the last couple months, maybe even over a year or so, I know some of my private community students are here, you guys see the impact and how important these assets are and how clarity building they are and how trustworthy your analysis then becomes when you have this type of analysis on the back end. Because this dictates where things will likely go, or it'll influence where they'll likely go. Sometimes they're disjointed, sometimes they consolidate and don't really do much. And then again, you take that observation, translate that to the asset of your choice, whether it's currencies, the GU or EU, or the indices, you see why things stop or stall in the market. You can build an argument as far as why, or it just helps you identify the current condition. If the bonds and yields are racing towards a particular direction, that generally opens up things on the indices and the DXY. And again, if these are consolidated, not doing much, or don't really have a dedicated direction that they're headed in, obviously, you'll see that translate to the indices and the DXY. It's not a be all end all, obviously, but it's just one of those things that happens more often than it doesn't. So yeah, looking at this asset class, we can see how. Let me fix the view real quick. So we can see how there is a crack in correlation here. on this monthly chart. A little bit different than what the bonds showed. The bond yield, so we can see that this has the SMT here slightly. So we're going to want to keep that in mind. We do have a volume imbalance here. We have a fair value gap in here. Nothing else really. So let's map that out here. Let me actually keep that. Actually, let's remove the drawings. Let's start fresh like we did in the other one. All right, so got this high here. It's a monthly high. It's a previous monthly high from, what is that, April of last year. Pretty interesting how we blew that out. That may trigger price to retrace, right? You can see how the behavior was. It ran way up into this bearish order block, this massive bearish order block, kind of rejected off the high there. So we want to see what's going to take place as far as, you know, what we're going to expect. We do see that the last couple months, the last 2 months have been dramatically bullish. At least the last 2 months. So it's not unreasonable for them to have pulled off the high there. But again, you go look at the overall view. What has this asset done? You know, what kind of environment was created? Was it a massively bullish move, or was it a consolidation, or was it a indecision candle? Well, if you look at these other ones, right, you look at all three of them together, basically created an indecision candle, leaning bullish, but indecision candle nonetheless. You know, so we got this hard rejection. We have a volume imbalance in here. So we're going to keep that in mind. But yeah, let's just keep tabs on this monthly high. Why is this important? Because we blew that high out and we have an SMT. And once we blew it out, we came right back to the high. So we pulled off the run on stops here, right back to the high that was taken out. We blew out previous month's high as well, right? So that was, I mean, this shows you the significance from what I was talking about in the other assets, right? If we were in this candle, or if we were in this candle going into the new month in January, identifying, you know, what could be potentially significant, this high here, doing exactly what we did here on this monthly chart, right? Outlining the previous month's high, going into a new month, you can see how that would have been important, right? We're so close to that monthly high, it was only logical that price could have a likelihood of blowing that out, especially when the bonds were dropping, right? And this was going to be assumed to be bullish, right? Because they're reverse correlated. So you can see the importance of identifying these levels. And then once they get close, right? Once price is close to one of these levels, whether a previous month's high, previous week's high, previous day's high, those levels a lot of times get utilized, you know, so they're very easy, continuously repetitive liquidity pools to pay attention to and study how price uses them, what price does when it blows them out, right? Does it blow them out and retrace more often than not? Once those levels are met, or, you know, is there any other type of characteristic that you can note, right? So we have that monthly high to keep in mind. We got this. It's going to turn into a previous month's high, but we're going to just label this as the monthly high. All right, and then monthly low. Right, so again, if price is going to, say the new month was to start, right? Say we're going into February in a couple days, right? So you use this understanding, or use this information as we go into the new month, right? And just consider it from the last couple of months, right? Go back and do some back testing with what we've talked about today, and just observe. You know, keep in mind some of the things that we've discussed here. some of the important levels, and then just go study these levels. Because I highly doubt, well, I know for a fact that majority of people that trade that don't use ICT concepts, or even a lot that use ICT concepts, don't consider this very simplistic way of viewing liquidity. There's a list of liquidity that I generally give here and there that has to do with these, and then a couple of the other lower time frame ones like session highs and lows, previous days highs and lows, new week opening gaps, new day opening gaps, things like that. London high and low, it's a previous session high and low pretty much. Those are all stagnant. They never will go away. If price is going to print, and we're going to continue to have sessions and new days and new months and even new years, there's always going to be a liquidity pool that you can frame an idea off of, And of course, if this opens up a new month and we're going to possibly be a bearish month, if it's going to reach down for, say, this fair value gap, this outlines the first liquidity pool if this is the time frame we're doing this observation on, right? If the next month is bearish and we're going to target something to the downside, we have this volume imbalance, first of all. But then after that, we have even the wick here. You break that down into a quadrant. You have all four of the levels in that quadrant to target before we get to the monthly low. But if overall next month is going to be bearish, what could potentially be the downside objective for the month? If the next month is going to be bearish and it's going to extend to the downside, most likely it'll reach for this previous month's low. It just has to do that, right? I mean, it could just stop and stay inside of the monthly range, like this range here. It could very well do that. But if we're assuming that it's going to be a fast-paced month, and we're going to try to observe that, and maybe it starts showing evidence on the weekly, on the daily, that it's going to do that, right? Price can easily get down to something like that. More often than not, the previous days high and low, previous weeks high and low, previous months high and low, if we're close to those levels are going to be utilized. Whether you can frame out an opportunity around that and trust, the particular delivery that gets you to that point, obviously it's, going to be subjective, to your skill set, the things that you observe, the model you use. But again, this is just like a very umbrella way of viewing liquidity. People overcomplicate it. They overcomplicate what liquidity points are important, not knowing that there is a huge amount of liquidity in front of you that can be labeled and consistently viewed and studied and navigated. And again, it doesn't have to be rocket science. It really doesn't, right? At first, it may seem like it is, but there's ways to realize what's truly important right now, what's truly important for the week, what's truly important for the month, and even what's truly important for the next quarter. Which, when we go into the next quarter, which is going to be the second quarter, we'll have a discussion about that as well, right? But for now, we'll stick to this. But yeah, so again, we have this volume imbalance. We have a fair value gap down here. If it stays like this and opens up a new month next month, which obviously is going to at some point, I don't think this candle is going to change dramatically. Again, we're on the monthly chart. So likely the range that we're currently trading within from this monthly high to this monthly low, those are probably going to stay intact. So the trading is going to be done within this vicinity here. Maybe we stay below this high up here that we took. Maybe it breaks up a little further and closes this candle a little bit higher. We'll see what takes place with FOMC and federal fund rates coming. That could be the case, but we'll wait and see. But as far as what's important on this level, right, or on this time frame on this asset, you can also take these levels here and move them to over here. We do want to keep tabs on the fact that there is this SMT here. We're on the monthly chart. It's like it's a snail, a turtle's crawl. So it's not going to dramatically respond off this high if it does have a downside move. But if it does start to decline off of this buy side run here, we now have targets. We now have reasoning as far as why it could do that. We have SMT at the highs, right? So we can start to build a narrative and justify this bullish run turning bearish, whether that's going to be long-term or not. obviously that's something that's a rolling observation. But if it was to turn around, we have an argument now that gets us in front of that, and allows us to possibly frame out something to engage going from bullish to bearish if that does take place, right? So if you guys got any questions about that stuff, let me know in the chat. If you haven't liked the video, definitely like the video. If you've been getting value, if you hang around here for a long enough time, I'm telling you, things will change. Look at what Tony said and a lot of the other testimonials. I appreciate you guys' time you spend with me as well. Got to always let you guys know that I appreciate y'all. But yeah, if it's not asking too much, definitely like the video, subscribe, share with your friends if you think they can get some value from the things we discuss here. Again, it is greatly appreciated. But yeah, so this is pretty much the observation that we are going to keep intact here on this asset class. We do have a volume imbalance here. We do have a fair value gap in here. And then again, we have the monthly low here, monthly high, monthly low, fair value gap, volume imbalance. Very similar behavior across the board. But again, we do have that SMT at the highs. So we got to keep that in mind. So now we go to the weekly time frame. And we can see, so if we take a look right here, right, let's just look at this view for a second, right? So what stands out to you looking at this price delivery here? Right, we are really zoomed in, right? Don't worry about, all the other things. The specific identification of a particular level that I want you guys to be able to pull out. It's something that ICT mentions all the time. It's very basic when I mention it. If you don't see it just yet, you'll be like, oh wow, maybe you did see it, maybe you didn't. But yeah, what are some levels here specifically that stand out to you? Let me know in the chat. Aside, obviously, from the ones that I have labeled here. All right, what stands out? The gap, okay. You're talking about this gap here, I'm assuming? So that is a good observation. Is there anything above or below that that also stands out? Aside from like a fair value gap or a volume imbalance or anything like that. The gap combined with a breaker block. Breaker block. We can't really see a breaker block here unless a fractal low was to be violated or like a shift in market structure took place. That is a decent observation. If we did drop down a little further, weekly volume imbalance, BISI below, potentially forming a bearish order block. Those are, so everything that you guys have mentioned are great observations. I'm thinking a little more basic than that, right? Those things go in conjunction with what I'm trying to get you guys to be able to see here, right? So let's see if you guys can see what it is and point it out. So there's two of them. There's one above and there's one below. If you guys can't get it, I'll give it to y'all in a second. I want to see if y'all can pull it out, right? Remember, highs and lows are also PD arrays, right? Significant highs and lows, those are also PD arrays. So just a slight hint. 3-week low, okay? Relative equal lows, relative equal highs, right there. Where are those? We have relative equal lows here, relative equal highs up here, right? Very basic, right? But again, all the things that you guys mentioned, those are amazing observations. Those are all things that you want to pay attention to. But to keep things very, very simple, you take some of the other PD arrays, and if you couple them with equal lows or equal highs, right? Say we do stay below this as a bearish order block. It's more likely that this is probably going to reach down for this fair value gap at that point, right? Yeah, see, the reason I wanted to try to make you guys point that out is to justify some of the things I was mentioning earlier. As far as, it doesn't have to be overly complicated. The first thing that we go into the charts and look at or try to look for are the complexities, right? Like where are all the PD arrays that we could possibly look at in price, you know. And again, the things that are relevant, like close to price, obviously that's important, right? But again, one of the things that ICT says you want to make sure you really, really drill into your focus is when you look at a naked chart, where are the equal highs and equal lows? Because once you're able to identify that, those are probably the heaviest magnets in price, right? Because price does not like to leave smooth edges at all. Because what does that mean? That means that people on the retail side of things, or the people that use traditional retail logic, right? We're all retail traders, right? But the ones that use the traditional tried and true 90% losing style in terms of retail trading, they see this as strong support, strong resistance. We see that as the opposing liquidity to pair our sell side delivery, right? Our shorts, right? That's sell side liquidity that we can pair a sell side entry on, so then we can take profits on. Or if it's running to the buy side, that's where we're basically going to pair losers to the buy side, with our buy positions, right? If we take a buy here, where could we take profit? Ideally, it's going to be at a place where buy side liquidity is at, right? Of course, again, all the PD arrays that you guys mentioned, keep those in mind. I'm not saying put that stuff away and don't think about it as if it's not important. All those things are important. But if you couple the observations you guys just mentioned with equal highs and equal lows, especially on the higher time frame, and keeping in mind that things don't dramatically change, and sometimes there's retracements in a bullish trend, sometimes there's retracements in a bearish trend, you start to be able to keep things a lot more simple, because if you can identify the equal lows and equal highs, then this bearish order block would be a whole lot more significant if it was to start to deliver to the downside. Because now you have a bearish order block mixed with a fair value gap, a small volume imbalance in there, all coupled with a relative equal low. Or if you think that price is going to maybe respond off of this, or maybe the wick here, right? Say it respects the midpoint of that wick, which it's doing so far. Maybe it starts to smash higher, right? Well, if that's the case and price does hold, then obviously we have equal highs up here. Maybe there's a fair value gap or something up here that could have been coupled, right? There isn't right now, right? Because we kind of blew through this one, kind of smashed through the midpoint of this. So we'll have to see if that's going to even hold any significance whatsoever moving forward. But because price has been super, super bullish, right, it wouldn't be unreasonable for us to look at this, see the relative equal lows down here, and logically think that if price uses this bearish order block like Maddie mentioned earlier, it wouldn't be surprising if it was to use this, respond lower, and then eventually try to target the fair value gap with the equal lows. Right, so the first thing you want to look at when you go into the chart, and basically the reason I pulled your attention to identifying this simple liquidity pool is because, the first thing you should see is equal highs and equal lows when you get on the chart. Where are the smooth edges, regardless of the time frame you're on? If you can identify this, preferably on the higher time frame, because those are the most strong levels, right? The strongest pools on liquidity. Then you can reasonably drop down with confidence as far as what price is going to target when you start to mesh in some of the other more advanced PD arrays. Because again, highs and lows are PD arrays, right? The monthly highs and lows, the weekly highs and lows, and the previous daily highs and lows. Again, people forget that those are part of the PD array matrix. They're the last one that price likes to target in a lot of cases. Or if you're looking at the PD array matrix table, they're on the extremes, right? They're on the sorry about that. So they're on the far end on the buy side and the far end on the sell side when you're looking at that PD array table, right? But again, don't forget that when you look at price, first thing you should think of, where are the equal highs and lows, if there are any, right? Because those will play a role in conjunction with the other PD arrays. Like this weekly candle, right? If it's going to reach down to these levels, again, going back to what we were talking about today and what we continuously talk about on a regular basis, if price is to push down to that level, Maddie mentioned the bearish order block. right? Well, if it's going to use that bearish order block, what is the first target we can operate within? Before we try to aim at something like this, or before we even aim, if it was to go higher, to aim for something like this. The first one to aim at is going to be that previous week's high and previous week's low, right? Because think about it. If this chart is going to reach for a PD array of some kind, in this case, let's use the fair value gap and the equal lows here as the assumed target for the week, right? If it's going to deliver down there, what is the first thing you see? Many people would not have said it's the previous high and low of this current candle. Majority of people would not have said that, right? Majority of them just don't look at it in a simplistic way like that. But it can be that simple, you know. The small, simple things in price delivery done well, the basics of the basics, are the things that will get you over the hump of lacking consistency to actually being able to have trustworthy consistency. Because these small little observations in price and how it operates, right? It's kind of using power of three as well, right? Just thinking about power of three lens, you know, the previous week's low, previous week's high, right? Price may open up in this current week, may run up a little bit, maybe do what Maddie mentioned, use this order block to act as resistance, or maybe even this previous high that we showcased earlier, right? Maybe it stays below that and then starts to deliver a downside candle off the basis of, you know, this maybe being a bearish retracement, which is obviously permitted. If it was to get down there, that doesn't mean that the whole observation for narrative has changed. That just means it may be a retracement to then continue and maybe target the equal highs here that were left. But again, you know, think about it this way too, right? If you were smart money and you were looking at price, knowing what we know about how smart money uses liquidity, where is the opposing liquidity located, right? Knowing what we know about liquidity and how they like to pair sell side with their buys and buy side with their shorts, right? Because they have to have a winner and loser, right? Where is the opposing liquidity at a reasonable discounted level based on the range here for them to possibly take a buy at a fair value or a discount price, or at least close to a discount? That's down here. People's sell stops are down here, right? Just like how they ran up above the highs here and then rejected. This happens all the time. They will blow out a significant high and then pull back on them. Why? Because them going up above the buy side here for this example here, they triggered in buy stops. They punched out anyone's stops that were up there, either protecting them when they were taking a short or to trigger them in to continue to buy, thinking that this is going to be strong support, right? Well, that same idea can take place if they run down below equal lows, which if you're a buyer in here, you probably moved your stop up here if you trade off this weekly time frame. The stops are probably resting right there. Maybe they were dumb enough to push them all the way up there. Well, I mean, if they were profiting off this, that's not a dumb observation, obviously. But still, you know, a lot of people have stops down here, and it's just logical if they were to drop lower, understanding premium and discount dynamics as well, right? If you're going to buy something, you want it to be at a discount, ideally, right? If you're trying to sell something, you want it to be as expensive as possible, as premium price as possible, so then when you sell it, you can make the most money, right? You know, that dynamic somewhat works in the market as well. Obviously, it's a little different, but the basic structure there is in play all the time. That's why premium and discount navigation is important as well, right? But this is why some of these levels are so important, right? And what the first thing you look at in the market when you look at a naked chart on the higher time frame or any other time frame, where are the clean equal highs and lows, right? Where are they? Because they're there all the time. You know, keep in mind previous day's high, previous week's high, previous month's high and low. You know, all those things are relative. You know, in this case, these are 2 weeks of equal lows here. So if you think about it, that's a large liquidity pool. So again, it would be totally logical for them to blow that out. And, or if they were going to continue going higher, it'd be logical for them to blow that out too. I would not continue to assume this is going to go higher until the midpoint of this weekly bearish order block is violated at this point, right? So yeah, before I move fully forward, does all the stuff that I just mentioned make sense? Do you guys have any questions or comments about any of the stuff that was just discussed? Because the stuff I just mentioned are fairly basic, but again, people overlook it, right? They try to overcomplicate it. And I showed, you don't have to always go in there with the overly complex mindset. The liquidity pools, there's liquidity pools that are consistently there, and equal highs and lows are always part of that equation, because highs and lows are PD arrays, and a lot of times they're mixed with these other more advanced PD arrays. Okay, makes sense. Cool. All right, for sure. So yeah, what to take away from what we just discussed, right? Always just highlighting what ICT mentions all the time. Look at the smooth edges. It doesn't always have to be the whole entire chart. When we're looking at what's important to us based on the things that we've discussed today, it's very important to remember what's closest to us in the most current candle. If we're on the monthly chart, right, look at the highs and lows of the previous month. What is in close proximity to that? That is our current range, right, at least from a monthly perspective. So anything down here, anything up here, none of that matters right now, right? And then if you go to the week, right, you have all that stuff labeled out already, right? So now you take that logic and move it to the current week or the previous week. That previous week's high and low gets you a little closer to price. And if it is going to target something above, whether it's the equal highs, whether it's this previous month's high, whether it's the equal lows or previous month's low or this fair value gap, it's going to have to get through this previous week's range. So again, that you could see how that narrows you in a little bit more when it comes to identifying current important liquidity for price navigation, right? And then, of course, now we'll move to the daily time frame. We can see that there's been a lot of gappy behavior in here, right? A lot of times, the bond market has a lot of gaps in it for whatever reason. But yeah, so this gap here may be significant. Again, we have the previous week's high. Whoops. Right. The weekly high here. All right, so just based off the things that we've discussed here across the assets that we've currently looked at, we have a good amount of information to start framing out a narrative, right? Like, what is price going to reach for? We have a more focused view as far as what that could be now. And then of course we keep in conjunction with what the higher time frame is doing, what it could do from that monthly, from that weekly, and things start to become a little more clear, right? A little easier to decipher, right? And then again, we have the equal lows here, right? So put sell side there just for completeness sake. I'll put Candyland. Right? So yeah, now looking at this daily chart, right? Having the same logic going from that monthly view down to this the weekly view, then to the daily view, breaking down those important levels on each of those time frames. We can now use the daily in the same way, right? We can now look at what is the previous day's liquidity. What's a previous day if Sunday is the day that we're looking at this, right? We look at Friday's high and low, right? That's the previous day, right? And then aside from that, right, if let's just assume the price was going to go lower. What's another liquidity pool before we get to the weekly previous low or the previous month's low? Or the equal lows that we just talked about, right? It's going to be Thursday's low Wednesday's low, and Tuesday's low, right? Which again, that's the previous week's low, right? So inside the previous month's high and low, inside the previous week's high and low, you now see that there's a lot more ways that you can now start to frame a narrative, right? Aside from all the other tactics that we utilize, you know? So now we have a liquidity pool here. We have a liquidity pool there. Yeah, see, so that makes me a little suspect, right? Being able to point out a head and shoulders, right? Makes it a little suspect. It may happen, right? Yeah, whenever we see those types of retail patterns, I'm always a bit skeptical, right? It's good, you know, we'll definitely note that, obviously, and see how that works, right? Because isn't it like you cut the neckline or something and it should stay below, or some way of navigating that? But yeah, if it was, again, to hypothetically drop down and go lower, and use that bearish order block that was mentioned earlier by Maddie, right? So we'll map that just to have that observation there, right? It's a weekly bearish order block, because again, that's going to play a significant role, this weekly order block level, as far as whether we're going to continue to press lower, or if it's going to give us a signal that we can trust it going higher. You know, trusting it to go higher, I would have to see price smash above and break through the midpoint here, because we have the equal low and the fair value gap down there that I mentioned, right? So I would have to see some significant price delivery pushing away, right? So break this order block in half. We can now see the midpoint. Make the thing a little smaller. Right, so yeah, let's just pull back down to the daily. Right, so keeping that in mind, let me put this as a dashed line so it's more obvious, right? So yeah, if price was to hold above the gap here, right, this large gap from the close here to the open here, we also have a gap in here. I'm assuming these are new day opening gaps, right? If you go back in, you know, the previous week, look, break these candles down a little further on the lower time frames. I'm assuming that these are large new day opening gaps. All right. So, wait, wasn't there a holiday or something on Monday, if I'm not mistaken? Last Monday? Yeah. So, okay. So yeah, that large gap that we see there, this is from Monday. So yeah, you could see it right here from Monday's trading because of the holiday. So that's a big holiday gap. So we can measure that out, break that in half, and the midpoint of that gap, that can also be a validity area. Because, you know, if it's going to run higher, right, it's going to have to stay above that gap. Generally, you know, if it does respect a gap like that from a holiday or something like that, we like to see it stay above the midpoint. I did kind of trade through it on both directions. You see the down wick here, down delivery, up delivery, and then this large move up here. So yeah, we're going to have to see from the midpoint of this gap, right, you can measure that out. Get a midpoint reference for the holiday gap. Don't want to put too many things on the chart. Yeah, MLK's birthday and our amazing president got inaugurated. So yeah, God bless America. Just saying. But yeah, so make this yellow. It's a holiday. %. So again, this will just be another area of possible validity for us to see it act as a possible support level. If it was to smash through that, obviously that could be a problem. Then obviously we got the low here of the gap. Then we have the range in here as well. It's also a gap. And then we also have the gap here. This is a new week opening gap. Okay, so the new week opening gap here could be significant if it does choose to deliver within that, because it could act as another reason why price will try to continue to go lower if it stays below that. So we're going to keep that in mind. All right, so we also got the midpoint here. Right, so again, these are just some more levels of possible reactive behavior, right? So you take these levels, transpose them to the lower time frames, you know, that you'll see that there's a lot of responsiveness that will take place intraday as the new week presents itself. All right, but yeah, these are pretty much the significant levels that I have on this asset. And so we're just going to have to see what takes place there. So again, we went from the monthly, figured out that range, dissected it down to the weekly range, got the levels for that price delivery, and then now all the way down to the daily chart, which you can start to see a lot more details as far as what levels could be significant on those lower time frames, regardless of whether we go lower or go higher. Currently, if you measure from this low to the high here, if you take into consideration the range here, we're actually dancing around an equilibrium level. So we want to observe and see if price is going to stay below that equilibrium. Again, if it blasts through, stays above this equilibrium point, maybe breaks through this fair value gap and uses it as support, smashes through the midpoint of this weekly bearish order block level, then again, those are all arguments to trust that price is going to continue going higher if we do want to see price get up and reach into this level. Because it's the end of the month, because we are now inside equilibrium, because the higher time frame has been overlapping pretty dramatically, because we have federal fund rate this week, because we have FOMC statements this week, there's a ton of things, including the January seasonality, which generally can be a little rough. There's a ton of things that are highlighting, hey, your risk needs to be managed properly, like we discussed in the start of the video. Okay, so all these things are very important because, again, a common question is, when do I trade? When do I not trade? How do I know when things are high probability or low probability? Well, if all these red flags are flashing in front of us, price has to show us evidence that it's not going to use those as reasons to consolidate. And again, these observations are in the bonds and yields that we've done so far. Again, this stuff is important to keep in mind when you drop down to the markets that are influenced by these markets. The bonds dictate or influence where the currencies, GU and EU, along with the indices are going to go. And the bond yields, which are these markets here, generally influence and dictate what the DXY is going to do. And if these are consolidated or have a bunch of red flags, or they're just not moving in any significant capacity, that sends reverberations to the indices, the currencies, along with the DXY. Right? So what does that tell you? That observation there tells you, hey, I need to lower my risk, lower my expectations, lower the amount of trades that I try to push. Because if you push in an environment like that, if you go back and look at some of the losses you've taken, keeping the things we've discussed today in mind, you'll see, oh, I was trading in a shitty market environment, right? Maybe I should have chilled and not taken 10 trades on Friday, knowing that all this stuff was taking place. You see what I mean? So yeah, just keep these things in mind, because this is stuff that experience teaches you. We hear that as a new trader and we disregard it until we blow 15 accounts, until we blow our life savings, until we sit there and feel like a failure because of months and months of us just doing whatever the hell we chose to do, whatever we wanted to do, didn't want to listen, right? Those lessons don't have to be learned through getting beat up and blowing accounts. You don't have to blow an account to learn. You don't. You just have to take good advice, study the good advice, and see for yourself whether there's validity behind it. And I'm grateful that some of you guys have taken it upon yourself to do that with the content here. I expect you guys to put me to the test, to see what we talk about, and go forward and observe what takes place and see if there's any reason to trust the stuff that we talk about here. And I'm grateful that those of you that have spent time with me over the last couple of years and recently the last couple of months have seen that validity. And I'm grateful that you guys spend time as much as you do, because there's a lot to cover, and there's things that we don't want to overlook, and I don't want to leave anything out, because that just sets you guys up for failure. And I don't like how that felt with me, so I refuse to pass that on to someone else. And I'm not the person that thinks you have to beat your whole account, blow your account, go through the fire to learn these types of lessons. Just take what's said, go observe it for yourself, spend some time using some of the things that we talk about, and then you'll quickly see, like, there's things that you don't have to do to learn certain lessons. And the validity behind the stuff that we talk about here is unmatched. It really is. And it builds you to the point of trusting the things that you're doing in the market. Because when you trade full time, like I mentioned, this, a little bit today and then last week, full time versus here and there are two totally different worlds. When you got to pay rent, these are the things you need to allow yourself to pay attention to. You have to have a thorough process. If you don't, you're asking to get punched in the face. You're asking to really mess your life up, because, who the hell wants to do something as a professional and be totally unprepared, not have anything organized, have no business plan, just go in there and just wing it, right? I'm just going to do it because I feel like I deserve it. Going in with that hope mentality, with no other back end, like planning, right? And skill sets built. I mean, it's you're asking for a world of pain. And again, it doesn't have to be that way, just like it doesn't have to be overly complicated, but there are specific things, like some of the stuff we mentioned today, they never change, and they help you tremendously to not only understand the markets, but also allow yourself to have clarity so you can build trust, so then you can perform in a profitable manner. So obviously not guaranteed, because, we all make mistakes. But still, there's things you can do to better your chances to be a successful trader. And I hope that the time you guys spend here with me, I hope you guys have seen that there's some of those tools laid at your feet. All right. So yeah, do you guys have any, the markets went insane last week. Expect the next 4 years to be pretty intense, right? Because trade and all these different things that take place in our economy, even globally, it's going to be a lot of activity, flurry of activity, right? So yeah, do you guys have any questions about some of the stuff we've talked about here in terms of identifying different levels, what's important, how to go from higher time frame to lower time frame, what to keep in mind as you're trying to map out a narrative? Again, these are things that not many people talk about, because guess what? Majority of people have no idea what the hell they're doing. Okay, they just don't know, and it's not their fault. But if we do know something that people should know, and we've reached some level of success, I feel, at least for myself, I feel obligated to try to pull people up with me, because this is an amazing industry. But again, you don't want to turn it into something that's a nightmare. It doesn't have to be that way. But yeah, you guys have any questions? If you don't, we will move on to the DXY and the indices. We'll kind of fly through those, given the fact that we have a lot of information already to go off of. But yeah, I hope all that stuff made sense. Don't forget to mark off this equilibrium point. Yeah. All right. So now we'll move to the currencies. Right. So given the assumption, just to review, while we go into the currencies and then the DXY and then the indices, I'm assuming that, the overall tendency may continue to go lower. I wouldn't be surprised, given that's the end of the month, that we give a retracement and start to favor a little bit more, pulling back to the buy side a little bit. With the bonds, that may also translate to the yields potentially dropping a little bit, going into cap the rest of the month. And then if the yields are going to possibly favor some type of downside, And if there's going to, in fact, be some type of continued retracement a bit in the bonds to the buy side a little bit, then obviously that may end up continuing to push this a little bit to the buy side as well. We can already see that we have began somewhat of a tendency to want to reach back into this exaggerated downside objective. It makes more sense too because we've hit this higher time frame fair value gap. We've had this outlined for a while. You know, we talked about this. We talked about the SMT, how that could possibly lead to price going higher. Like Tony said, almost everything we talked about in the last couple of weeks has came to fruition. So, you know, given that that's the case, right, and that things have started to make a run back, we're going to have to see whether that's going to be sustained or not. Let me remove some of this noise. All right, you can see here too that we came back into a new week opening up. I'll keep that on because it was kind of significant. So all right, so at least from what we see so far, right, we've blown out sell side, kind of left this low here. We do have an SMT here on this monthly time frame. Because it's a monthly SMT, we'll see if this is going to give us a strong move, right? We've blown past the down wick here. The response off this fair value gap has been fairly significant, right? So that's a fairly significant run, if I do say so myself. So we want to see if there's going to be some type of attempt to get up here to the volume imbalance in here. Let's just mark that real quick just to have that on the chart. Something you'll notice too that most people don't observe because they just don't study certain things enough, or maybe haven't had a chance to, is when you see higher time frame things like this, like a volume imbalance. A lot of times that volume imbalance, if you go down to the lower time frames to get like a closer look at them, a lot of times they're new day opening gaps, new week opening gaps on those lower time frames. So that's an interesting observation that probably a lot of people don't know. Okay, let's monthly volume imbalance. So that's a kind of interesting observation, right? So yeah, we got this monthly volume imbalance. We have this previous month's high. You know, same thing as we did on the other assets. Not going to go over it too much at this point. But yeah, we have a monthly high here, monthly low. Clearly, the monthly low is not of interest at all at this point. We've responded off of this monthly fair value gap. Right? It's also a weekly fair value gap too if you go break it down. But we see the monthly fair value gap response reacted aggressively off the SMT at the lows we pointed out last week. And then it gave us a run for our money to the buy side, right? And then we come over here to the bonds, right? If we're going to get continued buy side, or if we start to see things go higher, right? Obviously, to justify that even further, as far as are we going to be in a actually trustworthy long-term run, in this case, possibly to the buy side, we'd have to see a change in the bonds to fully get behind it. Because if the bonds were to just turn around and just start smashing lower, then obviously that may dictate that this is possibly just a small retracement that could then maybe want to continue to blow out the lows. I do like the response off this monthly fair value gap. This makes me feel as though we're going to possibly target the buy side up here. All right, so we'll see if that's going to be the case. This is a monthly high. So let's put the monthly label there. All right, so we have a previous monthly low here. Price is now well above it. Again, the response off this monthly fair value gap could be significant. Again, we don't change our overall narrative just because we see a bullish candle and a bearish run, right? We have to build a narrative using interest rates, intramarket relationships, which is pretty much the whole process in terms of what we do with these calls every week. and then just continue to see what is respected, what's not to be respected. Again, this is the current monthly high. This is a weekly high when we drop down. So we're gonna say, ooh, what was that? We'll save that adjustment for the weekly chart. Keep the previous monthly high. So again, if we do end up getting a buy side delivery, we're gonna have to. We'll eventually see this previous monthly high. We'll see this turn into a previous monthly high, and then that will likely get targeted. Again, we have a large wick here, so we'll see how the response would be from that. We have quadrants in there to also use in conjunction with this previous monthly high if we get above that. But for now, I mean, this is a massive wick, right? That's a huge wick justified by the delivery here from this monthly fair value gap, justifying the downside move turning to a retracement, right? In this case, currently, that's all this is a retracement. Whether the retracement is more long-term may determine whether the next week or so is bullish, right? It may be just reaching up on this monthly chart to hit this fair value gap up here. So we're going to have to keep that in mind and just observe whether that's going to be the case or not, right? So we'll label that out. I mean, you can make the argument, like we talked about earlier, to just label it like this. Include the volume imbalance, like we talked about. All right, so if we do continue to go higher and we find reasons to justify getting behind that, which we'll see further evidence of as we drop down, then obviously this would be our long-range target, at least for maybe going into the new month. I don't personally think that we're going to have enough excitement to get up there unless by the end of the month, unless the news event this week pushes us there. It's FOMC, right? Like, I mean, you know, it could end up doing that with the federal fund rate. You know, it could do that, but, you know, I'm going to be of the opinion that this may be utilized in the coming month, right? The new month may print and it may just jolt up there. And then if this is going to continue to be a downside move, then this should respond to the downside and then show little to no evidence that these levels are going to hold anymore once that time comes. Again, that's a little further view. Not important for the next week. What's important for the next week is obviously the high here that was created, which again, it's possibly going to be the previous week high, right? But as far as what we're looking at on this time frame, there's not really much more to go off of. We do have this fair value gap. We have this one here also. Maybe we can note that. Just to add further context when we go down to the lower time frames. Right. All right, so I'm going to just leave it with that. Again, we have the wick here, midpoint. We've kind of blown past that, so we'll see. We'll see if there's any justification for that to act as resistance. I don't personally think it's going to, any of those levels are going to be too responsive. They may have some response, 75% level. We pretty much came right to it. Very interesting observation here, right? Look at how precise the 75% level was. Ooh, get around the camera real quick. Right, closed right below that 75% level here. Right, so you can see the wick importance, right? Those quadrant levels, the midpoint, 25, 75. They're really, really responsive when you start getting down to those lower time frames. All right, so we'll just keep it like this for the monthly chart. Drop down, take a look at what the weekly is showing us. Right away, I can see that there's an SMT here as well. But this was a massive bullish candle. So we will see what happens, right? You can argue that this could be a possible shift, run on stops, possible shift in market structure. Again, there's that large view S&T that took place here from that monthly time frame. You can't really see no type of SMT on the weekly chart. There's really not much of an observation in regards to that here, aside from the SMT that's at the high, right? So we'll have to just study and see how the behavior is going to be inside these quadrant levels in here. Again, nothing changes unless 3 PD arrays on the given time frame that we're observing for narrative. In this case, the weekly chart, right? We were looking at the monthly chart a minute ago, but looking at this weekly chart, we have to have 3 PD arrays to break, to completely violate, in order for us to switch our narrative. This rule allows you to dedicate to one side of the market and look at any opposing view as a retracement. So in which you can use that information to basically map out the risk profile you're willing to take, aside from all the other things that we talk about, validating high probability or low probability or consolidation markets. You know what I mean? So yeah, keep that in mind. Okay, we need to see 3 PD arrays break in order for us to be like, all right, we're going to target this high. I need more evidence than just pushing into, the previous couple candles. Especially when there's an SMT at the highs. We can't trust that this is going to be a massive bullish run unless it's going to provide evidence. It's going to have to provide evidence. Same with this. This can easily just turn here, drop lower, use this wick and continue to drop, justified by all the stuff we talked about earlier, and then make this whole entire run turn around and start to attack the lows again. Because again, the bonds and yields dictate or influence heavily where the currencies are going to go or where the indices are going to go. Okay, it's the way it is, because currencies chase yields and interest rates. So if we're going to justify a particular move in the currencies, especially, we have to have the bonds on our side, and then the reverse view on the yields, because that's what DXY faces, right? That's what pushes DXY is the yields, right? The yields push the DXY. The bonds push the foreign currencies, that being GU and EU, and the indices, right? That's just fundamentally how the financials on the back end work in terms of why things move and stuff like that in the economy, specifically with these assets. The currencies chase yields and interest rates. They dictate where the foreign exchange will go, right? And then all that dictates a lot of times, or has an influence on what we see or don't see in the assets related to those currencies, which in our case in America has to do with the DXY, right? That the DXY dictates in the reverse what could potentially take place in the stocks, because they're reverse correlated. And then again, bonds and yields, interest rate markets, they dictate where currencies will go, because currencies chase yields and interest rates. I hope that made sense. I hope it didn't confuse you guys. But that's a portion of things that can get real complex. Understanding the internal relationships between the interest rates and how they impact currencies and the economy and all that, with trade and all that. But again, a lot of that stuff isn't necessary. We just have to understand the relationship, right? What does that do in terms of price action so we can engage or make a decision, right? So yeah, looking at this, again, we have this monthly fair value gap going back down into some of what has taken place here, right? We now have this broken down into quadrants. So we'll see how the 25% level behaves. We'll see how the midpoint behaves, and we'll see if we even come back down into this level. I'm telling you right now, if this SMT stays intact, this is a bearish order block. Okay. Yeah, see, that's the thing. A lot of times when I get into the too complex aspects of things, when it comes to how, like in regards to the interest rates and, I mean, the 10-year, what a lot of people don't realize too is the 10-year yield generally is what impacts mortgages, right? Like the real estate market. So there's a deep rabbit hole you can dive into. But again, I always try to keep things in a way that makes things very, very simple, because it's easy to lose people in terms of focus, because I know it was easy to lose me when I was watching ICT stuff, trying to get my footing on things. And it's that I learned that you just have to understand what the relationships are. We can dive into all the complexities. I mean, definitely in my private community, if y'all want to talk about that, if that's something y'all are interested in, Maddie, if that's something you want to talk about. But yeah, it's the more simplistic view when you're looking at interest rates, because I know that when people study ICT's fundamental analysis stuff, they get lost because they think, oh my God, it's so complex. But once you spend some time with it, or if you get like a view or you watch or study someone that analyzes it in a more simplistic way, without all the extra stuff that overcomplicates it, which in my opinion he does on purpose. And I posted something on my Instagram that proves he does it on purpose, and there's more simplistic ways of viewing things. Like all of it's done on purpose to make it hard so people can't go and rip him off. And that's got to be respected. But again, there's complex ways to do things, and there's more simplistic ways of doing things. And when it comes to the relationships, or identifying things like intermarket relationships, or the impacts that bonds and yields have, or fundamental analysis, you really just got to know the relationship between one piece of information, what that impacts, to another, right? To the assets that you trade, and that, that's many times what we focus on anyway when it comes to all these overall analysis concepts, but yeah, that's something y'all want to talk about. We could definitely dive into the complexities of that. I struggle with this too. Had to learn how to read PDAs, then learn how to apply that logic to intermarket analysis. Yeah, that's just part of the process. You know what I mean? It's definitely part of the process. It's a puzzle, right? It's looked at as a puzzle. It's a very, very good way of viewing your journey as a trader in ICT concepts specifically, because there's a lot of puzzle pieces, especially on YouTube. ICT used to scatter everything around. Thankfully, for the masses, he has pretty much narrowed it in a little bit. But still, he still overcomplicates a lot of stuff. All right. And he, again, admits that he does it that way. So it's not even an argument that it can't be simplified. It can, So, but again, you have to have a good understanding to be able to simplify complex topics. That goes for everything, So yeah. But yeah, guys, appreciate y'all hopping in and chiming in, giving me your opinion on some stuff. I like to see you guys' thoughts on all this stuff. Gives me a good idea of where y'all are at. So, but yeah, so that's kind of the view for what we see here in the currencies. Again, we have this massive run higher, so we definitely want to watch how the response is going to be here. Because, I mean, look at the wick here. Look at the wick here. It's pretty balanced in the delivery, at least from this view, right? So we worked with sell side, worked buy side, all throughout this fair value gap. So again, depending on what we do here, if we break outside of this monthly fair value gap and push away from it, that means we probably won't come back to it. So we'll have to see what takes place. All right, Maddie, I appreciate you, bro. Just hit me up in the private community later if you have anything else you want to discuss. I appreciate you hopping on as always. But yeah, so keep that in mind, this fair value gap here, right? If we push away from it, mind you, we have worked sell side, buy side. I mean, we worked a lot of the sell side. Now we're just pushing through again to work buy side again. And when you work both sides of a imbalance and then you push away from it, aggressively away from it, like break out of it and then push, in this case, to the buy side, most of the times that will be utilized already, and it probably won't come back unless the overall trend is going to continue. So that's a very important observation we're going to continue to monitor. We got this bearish order block here, right? So we want to see what that does. New week opening gap as well. And again, we have a previous month's high. Looking at this weekly chart, this is the previous week's high. I'm not going to label it because it's going to be a little too messy. I want to keep the rest of this a little clean. The previous week's low, not really of interest until, unless price was to get down there. So I'm really focused on seeing what price wants to do here. Possibly look to target buy side targets But at the same time, we do have that SMT. So we got to see what that's going to be. Are we going to open up, drop a little bit, and then just totally get through the SMT and just invalidate it and use this monthly fair value gap as a launching pad to now look to target buy side? Or is it going to stay inside this monthly fair value gap and then just tank from this order block here and then go back to targeting sell side down here? I'm assuming that this SMT may have a significant impact and just continue to show us evidence that we may look to target buy side again. But again, we'll see what takes place. If the yields drop, DXY will most likely favor sell side. If the bonds were to drop, that's going to favor sell side for the indices, right? But if the yields drop, I'm assuming that we'll see the bonds want to rally at some point. Okay, and then if that takes place, the yields dropping and the bonds going higher, right? Then obviously that will pull the indices and the foreign currencies higher. The scenario of the bonds going higher justifies this run higher, right? If it is going to confirm that, right? That is what's going to take place. And then obviously, if that's going to take place, we got to see the yields drop and then frame out something targeting the lows or the other liquidity pools that we mentioned. But again, if this holds here and goes higher, and then this holds at this level and goes lower, then we'll see continued downside, and the upside observation will likely not work out, and the SMT here will be justified to the downside continued. I hope that made sense. If you guys got questions, just let me know. Yeah, I hope that didn't confuse y'all. All right. So yeah, with that being said, we look at the overall DXY view. I know we finally made it, right? But yeah, so price has declined here, right? So this is kind of suspect in terms of, what's going to take place. That may be hinting at us that the yields, if the yields favor the sell side here and the bonds end up trying to rally up, given the fact that we've been so, one-sided in this case to the downside and in this case for the yields to the upside, if that stays intact, right, and turns around for the yields and goes lower, then we'll push a lot lower and justify this big drop here to then start to push through. I'm assuming that if we bust through this fair value gap here and this order block does not hold, again, that would start to paint a narrative, right? If this high is violated, if this fair value gap here is totally smashed through and doesn't hold and we get below it, the midpoint here, if it gets violated, then obviously we would start to target even further sell side delivery. Yeah, exactly. I mean, that's the thing. Like, if you're a day trader, that doesn't mean you're a everyday trader. If you want to be consistently profitable, the more you trade doesn't mean more money. The more you trade means more risk, because you're going to stumble across a couple losses. It's going to happen, and the better conditions that you can position yourself within, the better chance you have at minimizing the amount of times you get your ass kicked. I mean, it's just as simple as that. And the things that we do here process-wise, although, maybe sometimes feel like it's the boring part, these are the things that get you out of bad positions. It puts you in a better market environment. It puts you in a more like effective condition to trade within, a more energizing condition to trade in, a more trustworthy environment to trade in, because if you're trying to buy and sell, you don't want to be second guessing every 5 minutes. Although, that those types of thoughts will be there, but having the skill set that we showcase here on a weekly basis and all the time in my private community, I mean, it relieves your stress. Nobody wants to be stressed out, okay? And trading as a profession is the most stressful thing you could possibly imagine if you're not prepared. And even when you are prepared, it still becomes stressful if you don't have savings or if you're not positioned well in life, at least with like a year of finances. So just in case you have a couple bad days, you're not going to freak out. It's very there's a lot of planning that needs to go into it. It's not, oh, I get a funded account and I'm going to quit my job tomorrow. That doesn't work that way. It just doesn't work that way. You know, it's one component to this process. You know, it's a vast amount of tools you have to have at your disposal aside from the trading skill set. Like, you got to have all these different things in motion, right? All aligned. And that may take a couple years aside from learning the skill set itself. You know, and that's the cold reality. It's a cold reality that nobody talks about because it's not sexy to talk about. But wouldn't you rather be ready for the storm versus getting caught with your pants down and then swept up in the tornado? I think you have a better chance of surviving the storm when you're prepared. You know, you have a better chance of being successful if you have all the different components that success requires. You know, that's aside from all the psychological skills and all the other things that we talk about technical wise, you know, which is a lot of the stuff we try to map out here. You know, more trades create a lot of cognitive work. Yeah, more trades leads to a lot of mitigation. Let's just say that. Exactly. I spent years rushing the process instead of doing it properly. And Tony, I'm glad that you have found your way here. I'm glad that you have had a lot of improvements. Nudie Fafa, you are the freaking man too. You've been telling me a lot of improvements as well. My boy Maddie that left, he's in my private community. He has done amazing things so far, learning wise. And everyone else that has spent time here, I've gotten so many good testimonials. It's very humbling, really. It really is. So I just want to say thank you guys again for the support and the time you spend here. Because you can be watching any other YouTuber that has a bigger following, that tries to sell you a dream and do all this other bullshit that's toxic to you in reality, but you choose to be here, and I couldn't be more grateful. So thank you guys. So yeah, So yeah, with all the stuff we've already talked about, again, we have the order block here for value gap. We have to watch and see if that's going to be respected. We may get a bounce from there. If we do end up seeing a drop, if next week opens up again, we got to use the same principles, right? The low here, we got the high here. That's the previous week's high and low. If we're going to target sell side at all, it's going to have to target the weekly low there, right? So keep that in mind. This fair value gap and the response we get, along with this order block in the midpoint, those are going to be significant. Okay, because you want to consider this too. If we were to blast through this becomes a bearish breaker as well, right? And then we would have a much longer deep dive to the sell side if that low here was to be violated. But obviously there's other ways to anticipate before it gets down there so we can participate in that move, possibly targeting the low there. And again, even if it was to short and sell, and this was our target, with the midpoint of the order block, we have the low here, we have the low here, all those things become targets, right? So as price moves, using all the things we've talked about today, and then even lows, like if we're on the weekly or monthly time frame or daily, every low that you see on each candle, right? If we're dropping, each low becomes a target on our way to that larger target that we may be targeting. All right. So yeah, we'll see what the response will be from here. Again, we have the weekly low here with the order block for a value gap. Now let's drop down to the daily. Right. We have to see if this is going to be some type of significant overall break or shift in market structure. Right. Let's take this down candle here. In the chat, tell me what this is or what this could be here. What could this PD array be? Especially if we just continue to blast on through it. Just tell me in the chat. Very common PD array. right? It is a bearish breaker. Okay. And so seeing that, right, that could possibly be utilized as other reactive levels, right? Now, in order for us to trust that we're going to continue to go to the buy side, in order for us to trust that we are going to continue to go higher here, in my opinion, we'd have to keep in mind the higher time frame here that we looked at, that weekly bullish order block, the weekly fair value gap that we watched. We got to see the response here. Now, if we get a response from here and we shift above this high, we break through the midpoint of this breaker block, right? This higher time frame breaker pattern here. The only time I would be able to trust that this move here is going to push us higher is if we break above the high here, right? So that would be a shift in market structure back to the buy side. And then we would be able to then target things like this holiday gap up here. Generally, holiday gaps create liquidity voids because there's no trading at all because of the holiday, right? So for us to trust that we're going to continue to go higher, we got to break above the high here. Otherwise, I don't trust a buy unless we break through that, because we have this breaker now. We have declined pretty aggressively. We just talked about how there could be a change in the overall delivery here. It may look to target the sell side here and reach for the levels down here, especially if we're going to see this turn around and go higher. But again, if the bonds go lower, if the yields go higher, that would justify this shifting market structure here and then targeting buy side. Right, so there's a couple of things that we got to wait for at this point, especially going into a new month and all the red flag things that we mentioned as well. Right, so we have this candle here. Let me see if some type of order block. I mean, there's like this little bitty baby order block here. We could definitely see, again, we want to observe and see what the response is going to be from this weekly bullish order block, this weekly fair value gap, right here. And we'll go from there. Right, we'll go from there. If we scrub over here, we can see that the open here for the month, right? Put a line from here all the way across. We can see that price went up, power of 3, drop back down below this open price here. So this is a bearish power of 3 for the month. So when the new month starts, you're going to want to map out the open price there again, and then continue to study month to month as well. It's another really, really good observation tool to study power 3 on the higher time frame and get you that much better in terms of navigating the higher time frame to the lower time frame and using the power 3 dynamics as well. Right, so again, for this week, right, we have previous week's high up here, previous week's low. We have weekly bullish order block here. We've taken out sell stops. Only way that we would try to continue to press buys and look for more buy side targets is if price was to break through the high up here. But then again, we'd have to continue to observe, because this looks like it's a possible bearish breaker. We have to see if this is going to even come close to that, given the fact that we may see the yields turn around and start to seek sell side liquidity. Again, we are at equilibrium. We're at a time where we can't have too strong of an opinion right now, because we've just came off of a massive bullish run. We've taken out significant sell side liquidity for the bonds, right? And things are just going, we're going into a new month as well, right? We're initiating the real volatility going into this new year, setting the stage for the next couple months. If it mitigates, I don't mind. I see things happening, especially with the news. So, so we got to see what the federal fund rate's going to do, because guess what? That federal fund rate is going to decide whether this is going to fall or if this is going to continue and continue to go higher. Everything's going to stay the same, so I'm not sure what that is going to do in terms of impact. So again, we're just going to have to see. It's a wild card week because of the specific news events that we have. And again, we have reasons for price to do either thing. I'd prefer to see us drop down and take out these lows here, right? Because again, we've taken out buy side. I mean, it's only right for them to come down and unseat these people down here. If I was smart money, that's what I would do. Right, we do got a area here that we could possibly watch, right? This potential bullish order block here. But yeah, we'll see. It's respected that so far. I didn't notice that earlier for some reason. But yeah, that's something you probably want to keep tabs on too. Again, we got that gap there. So again, whatever this does, it's going to impact what the DXY does. I'm assuming based on what we see here, if we continue to show resistance to these levels, then we're just going to continue to favor sell side. That'll then translate if this goes lower, if the yields go lower, and the bonds decide to turn and possibly target these buy side targets, then that would be justification for the indices to continue going higher. And I mean, even looking at the indices, we can kind of see that that may in fact be the case, right? The triangles at the top of the candles, Milwaukee, they are the fractal indicator. It identifies the 3-bar pattern called a fractal that ICT talks about, the actual fractal pattern that ICT talks about, because there's the wrong way of viewing fractals and the right way of viewing fractals. And the right way has to do with identifying 3 bars that change direction, either bullish or bearish. That then leaves like a high, an actual high that's valid for many things, for placing your fib properly at the right, most near-term structure to get an accurate reading of the current range you're trading within, or if you're using fractal pattern on the higher time frame, like for example the daily chart, like we are here. When a fractal pattern forms at a high, then the next 2 days could potentially be opposed to, say, the fractal high. It could turn it to downside and initiate a retracement. Or if it's at the lows, right, if you see a fractal pattern here, right at the lows, once it forms that fractal pattern, the next 1 or 2 days could generally lead to, in this case, a run higher, right? Whether that's a retracement or a total turnaround entirely, depends on the situation, obviously. But when you see a fractal high and you map it out properly, or a fractal low on the higher time frame, that assists you in a possible triggering of a retracement or an overall turn, like we saw here. Obviously coupled with other things, but it just plays a small role in identifying that type of stuff. Or it, on the lower time frames, can also help you identify proper structure to map out or frame particular ranges, right? Using the actual structure that's valid to get an accurate measurement. So that's what this indicator identifies, is the actual fractal pattern that ICT talks about. Because a 5-bar pattern that generally is shown on indicators that map out the fractal pattern, the 5-bar fractal, you're late to the party per ICT's advice, per his teachings, right? So yeah, hope that answered your question. But you're welcome, brother. Appreciate you hopping on. But yeah, so yeah, I'm gonna assume unless there is a fast response to the buy side from this weekly fair value gap, I'm going to assume that we're going to continue to see pressure on the DXY. And in that case, it's going to possibly continue to press us higher with the indices. Again, unless the bonds end up continuing to be weak. Because if that continues to happen, then we may see some sloppiness or inconsistencies in the way price wants to deliver. Now, again, if the bonds start to tank and, maybe we get up into here for the NASDAQ, maybe it runs up above the highs here and then gives a fast breakdown. If that takes place, then obviously, in conjunction with a bearish bond market, right, depending on what the fund announcement is going to be, if the bonds do drop, then this may end up just being like a setup for price running to a premium to then look to target the sell side. I see zero reason why the stock market should do horribly, unless something changes, obviously, because Trump is very positive for the stock market. Since he was announced, things have just been rapidly racing to the buy side, getting billions of dollars in investment to our economy and to our country. So, I mean, unless something totally changes, expect the fact that, things are going to likely, sentiment wise, overall for the economy, be very positive. Obviously it doesn't mean there's not going to be downturns and reasons to short, but at the current moment, I don't really see much of an argument for us having a very strong downside move for the indices. Just look at it. We had a pretty strong move here, but based on the response from taking the sell side here, that was all to just unseat people at this sell side liquidity level, right? They just unseated them and then rapidly left they left a gap here, a breakaway gap on the daily chart, right? And have just ripped away. And then if you look at the area up in here, right, the fair value gap in here, the NASDAQ tapped into it, but the S&P did not. We almost blew out the highs, right? So there's an SMT there at the lows. So that, again, that's another justification for us to possibly look to target buy side. Now, again, if you look at this chart, going back to what we talked about earlier, what do you see? Remember the drill that we talked about earlier, right? The things that we pointed out before we pointed out the other more advanced PD arrays. What do you see in price right now for the NASDAQ? Right? What can we see that stands out? Right? Let me know in the chat. Right? What do we see that stands out? First thing, when we look at a naked chart, we talked about it earlier. What do we see in the chart? Yeah, definitely. It's been great. It's been pretty intense. But what do we see in the chart that stands out from the conversation we had earlier when we were identifying PD arrays and talking about things? But the first thing I mentioned, right? What do we see in the chart that pops off the chart? Hopefully it pops off. If not, okay, you see the 3-bar. Okay. Remember what we talked about a little early in the call, right? When we were all pointing out PD arrays and the different things. Break of structure to the upside with aggressive movement. Last week's high and low. Okay, yeah, there's some of those. Those are definitely things to consider, right? That's all part of the process we're considering. And if those are the things that stand out, that's a good thing. But there's one specific thing, right, that I said when we look at the naked chart, even aside from some of the things you guys just mentioned there, right? Those are all obviously some really important things that we have discussed today. But what is the one thing when looking at, remember, highs and lows are PD arrays, right? And what highs and lows are some of the most reactive, some of the most important when we look at price, given the idea behind liquidity, right? Looking at the chart, what stands out with that in mind? Aside from order blocks, fair value gaps and all that, because I'm going to mix that in too, right? Because there's a fair value gap in alignment with what I'm trying to get you guys to point out here. So what is the one thing I'm trying to point you to? What stands out in the chart right now? Last week's high and low, that's pretty close. Aggressive movement to the previous highs, that's pretty close. What kind of highs though? Equal highs, exactly. Look at how beautiful the equal highs are. Keep in mind what we talked about in regards to this, right? When we first talked about the importance of equal highs and lows, right? So if the yields have relative equal lows down here, and there's a possibility for price to want to target those equal lows with a fair value gap, when we jump to this chart, if the S&T holds here that we just looked at on the 3 indices, right? If that S&T holds and the bond yields target those equal lows, because those are they have an opposing relationship to the indices, but a positive relationship to the DXY, right? If the yields are to go lower and there's equal lows and a fair value gap to target, I would assume that it's pretty likely that if that takes place, these equal highs will end up being the target mixed with this fair value gap as well, right? So there's equal highs here. There's a previous week's high, which Tony pointed out, or Nodifafa pointed out, and then Tony, you probably saw it, last week's high and low. So you guys saw that as well. But the fact that there's equal highs here, there's a retracement, there's an S&T, right? There's a massive race to the buy side. There's a likelihood that DXY may want to continue going lower. There's a likelihood that this may end up topping out here and turning to the fair value gap with equal lows coupled with it. Because like we said, when equal lows are coupled with a PD array, or equal highs are coupled with a PD array, that amplifies them completely in terms of them being super magnetic in price, right? And then of course, if we can get the bonds here to be bullish, right? If they could blast through the buy side, maybe target this fair value gap in here, right? If we zoom in a little bit, we can also see there's equal highs there as well, right? We can also see that there's equal highs there as well, opposed to the possible downside in the yields, right? All of that is in conjunction with the fact that DXY may be influenced to go lower with that in mind. And then we look at the NASDAQ with all that background information, we can start to seriously justify an argument that these equal highs will be targeted. That also brings into question these equal highs. Merge that in conjunction with this fair value gap here as well. Yes, there's a bearish order block here. But what supports that bearish order block? Are intramarket relationships supporting that? Maybe they end up, maybe eventually supporting that. But right now, given what we see here, everything from what we've talked about today, from intramarket relationships to identification of different PD arrays and different liquidity pools and just all the different relationships, we can see how all that meshes together to give us an argument that these equal highs are probably more likely to get targeted than price digging super deep down into the sell side here. Yeah, Tony, you see it on ES too, right? It's incredible. And just look at the fast response. I mean, there's no reason for us to even justify bearishness at all. And if we look at the bonds and yields, if everything goes the way that we talked about, the support behind our assumption that price is going to go higher in the indices is massively supported, right? And of course, nothing is guaranteed, but I'm assuming that if everything stays intact structurally, the S&T at this fair value gap, right? The continued buy side, the continued positive news coming out for the U.S. economy, right? The interest rate market release that's coming out this week, FOMC statements, what are those going to be? Is there going to be a lot of positive news that could justify a continued run? And the news events could very easily get us up and be the catalyst that gets us up above these equal highs here. Higher time frame moves. Here's another nugget for those of you that have stuck with me this long. The news event calendar. If you're looking for a higher time frame target to be met, in this case, we're looking at the daily chart. If you're looking for the higher time frame to be met, right, at a particular level, in this case, the fair value gap up here, or even if it was to retrace and target maybe the volume imbalance here. Regardless, if there's a higher time frame level that we're looking to see met, using the economic calendar, you can identify the day in which that will likely take place. It's going to be most likely on the red folder day. Institutional sponsorship has to happen for large moves to take place, right? So if the higher time frame, which is where the institutional players participate in the market, if the higher time frame is going to deliver to a particular level, institutional sponsorship has to take place. When do we know institutional sponsorship is scheduled? Using the economic calendar. Think about power 3 within that idea, right? So you can start to see why certain days of the week are so important. Tuesday, Wednesday, Thursday, right? Those are the expansion parts of the weekly range. Well, if we're looking for this example here, right, if this fair value gap is to be targeted, study next week and see if that is targeted off the heels of the red folder news event that comes out. Or maybe next week ends up declining and reaches down to here, which is, it's not what I want to see because we have SMT, right? So I'm going to go into next week assuming that, maybe we'll have enough energy to get up into here. And then obviously the rest of the month will probably be very lackluster. But because we have that news event, let's see what happens. Is it going to be used? Because either this level is going to be hit because of the news, or these highs are going to be blown out of the water because of the news. One of those things is going to take place, right? I'm assuming that because we're so bullish, and the intramarket relationships and all the background information is showing us that we're likely to continue being bullish if everything stays the same. I'm going to assume that the news is going to be used to blast off up here, given just how impactful this has been. And if it doesn't, right, then it's just going to be used to retrace and attack sell side a little bit. But we're still in bullish order flow. Right, so going into the new month, we'll continue to study and see whether that's going to continue to be justified, which I believe it will be. Right? February is a bullish seasonal month also. Right? For the most part, So we'll see. We shall see. So keep that in mind, though. The economic calendar can be used to identify. So you could think, when can we expect this to be attacked or this to be attacked? There needs to be institutional sponsorship. When is institutional sponsorship taking place? During news events. So you go and look at when are the news events. Most likely on those news event days, that's where a large range is going to be presented. Right? Tuesday, Wednesday, Thursday is generally the expansion in the weekly range. So if we take those pieces of information and we identify, okay, this may be targeted. Okay, let's study and see if the news event will get us there and how the news is used to get us there. Or if it goes higher, which is what I would like to see because of the SMT and all the other things we talked about today. Right? Let's see. Is a news event going to be used as the catalyst to get us up into this level here? Right? It's a fascinating study, just as fascinating as those of you that have watched the bonds and yields from all the stuff that we've talked about for the last couple months, and for some of you a couple years. It's the news impact towards a particular direction in terms of using it as a timing tool for large range expansions to higher time frame PD arrays is just as fascinating of a study as it is to see the bonds and yields dictate or influence heavily where the DXY and the indices and the foreign currencies will go. All right? So just a very interesting nugget to give to you guys, another nugget to lay at your feet for those of you that have spent so much time with me and continuously show up. And I'm grateful to hear you guys making leaps in your understanding. It's extremely humbling, I'm telling you. It's the whole purpose and why I'm even public. I could just be living my life, which I do anyway. But it's one of the greatest fulfilling feelings to see you guys improve from the time you spend with me. Meeting you was life-changing. Tony, you are awesome, bro. I appreciate the love and support. And I really hope that your time here is seen as well invested time. I try my best to give you guys value in this most simple way. So I appreciate you guys as well. You guys are amazing. So, and if you guys get value from the video and you haven't liked the video or subscribed to the channel, definitely do so. I appreciate you guys' time here. And but yeah, so are we clear as far as what our assumptions going into the new week are and what we are expecting for the coming week? Are we clear on that overall topic? Because we don't even really got to dig in too much to different levels here. We have the whole process. We have the overall assumption. And then obviously with the skill sets that I've given you today, or the little pieces of information that are universal to every asset, obviously you can quickly go into the market here on these assets or gold or any other market and start to decipher which levels are very important and what range of levels, right? Different levels you should be looking at. Yeah, Nutty Fafa. Okay, if you say so. If everything's clear to you, I'm assuming that everything's clear to everyone else. Tony, if you could just give me a confirmation real fast. If everything's clear to you. Anybody else that is here live with me, if you could just toss a comment in there. Yes, and the comparisons are there. We just have to wait. Yes. Yes, Sunday. So just one more little review. So Sunday for weekly range, right? Sunday, Monday generally is consolidation manipulation. So whatever your assumption is on the higher time frame or your draw on liquidity, expect Sunday, Monday to go against that. So don't get fooled if you're bullish and it goes bearish on Sunday and Monday. That's what we want to see if it's going to be a bullish week. Or vice versa, if it's a bearish anticipation, we want to see Sunday, Monday go higher and consolidate and really not do much and reach for a PD array, opposed to what our higher time frame view is. And then Tuesday, Wednesday, Thursday, generally those are high impact news event days. Generally those are the days of expansion, aka, it's because of the high impact news events, and institutional sponsorship is needed to push price. And that's why it can be used as a timing tool, the economic calendar, to frame out when a particular PD array can be utilized or attacked. The economic calendar for the higher time frame is like the macros for the lower time frame. Right? I hope that clicks something in your mind right now. It's a fascinating study to go walk forward with. I learned that 3 years ago, and it was literally insane. I was like, holy crap. I could really map out my whole life around the economic calendar, my trading, and this, the different kill zones and macros. I don't have to spend 24 hours a day on the chart. I can just, even on the higher time frame, if I'm a swing trader or a position trader, I could use that. Wow, that makes a lot of sense. Damn right, brother. I'm glad it makes sense. Because it's one of those things, and it makes sense, right? Like why that would be the case, right? Because we need institutional sponsorship. The only majority of the time, institutional sponsorship is scheduled in the market, the manipulation, right? Or the large volume of price delivery that comes from the news. And if we want to see a higher time frame move deliver from, say, a fair value gap or a liquidity pool to another higher time frame liquidity pool, or at least start the march towards it, right? We need institutional sponsorship. Where does that come from? The news, right? So I'm glad that clicked, brother. I'm glad that clicked. I'm glad I went back around on it. I think that was a better way to explain it, right? The economic calendar for the higher time frame can be used like the macros on the lower time frame, right? But, the economic calendar is for the higher time frame, and the macros are for the lower time frame engagements, right? So even if you're a swing trader, you could think of it this way as well. I've seen a lot of YouTubers get smacked this week. Meanwhile, I still have everything marked. Damn right. And my entire private community and you guys still have an account. While these dumbasses blew their account. Hey, I don't mean to laugh, but hey, it is what it is. It really is what it is. And it's heartbreaking, but they should stop trying to do everything in a way that is just to get attention. If you're just trying to get attention and you're not doing things as a professional, being a professional should get you attention. If it doesn't, then, it is what it is. The whole point should be, at least for me, I look at YouTube and my private community and anything that I offer in terms of sharing my time with someone, I look at it as I'm trying to pull them up. Sometimes it needs a paywall for people to take it serious. Some people like you guys, it doesn't need a paywall. It could just, You can pour into some people and they could care less and they complain and don't even apply things and still complain, or they are like you guys and you apply it and you see what's happening, and we can hang out and have a good time. And like Tony said, it's life. It really is life changing. These things, the things that we talked about today, are game changing. Okay, and we're barely scratching the surface. There's so much more stuff that we're going to talk about this year. There's so many more things that we could talk about all the things that we've talked about today. There's even deeper levels, which, we'll get into a lot of them this year. I'm sorry. I don't have remorse. You know what? I don't have remorse either. I have to agree. I completely agree. I completely agree. I don't want to be mean, right? Like, I'm not a mean person. But at the same time, I think lying on the internet to pull people in for no reason, to then make them think they're doing something productive and wasting precious time that they don't have, just to end up failing eventually because of false information, I mean, that is sickening. So yeah, I have to agree with you. I got no remorse. I'm a nice person, but some people that are in this industry don't deserve kindness. They deserve to be honestly spit on. Okay, so just my opinion. Yeah, you're right, Tony. Education, it comes first. The foundations, they come first. And I hope that you guys have been equipped with that. Again, I'm going to just make sure one more time. So everything that we've talked about today, it all makes sense. The assumption as far as where we think NASDAQ's going to go, along with the other indices, and why we think they're going to go there or not. Timing-wise, what the importance behind the economic calendar, breaking things down from the monthly, weekly, daily, finding what's most important to us, different PD array discussions we had, everything that we talked about. Does all that stuff make sense, you guys? Just let me know and we will put a ribbon on it. Unless y'all got more questions, because I'm more than happy to answer more questions. Yeah? Okay. Perfect. All right, well, I think all you guys follow me on Instagram, right? If you don't, definitely go follow me on Instagram. You could definitely DM me there and we can definitely have close contact. Or, of course, you guys can just leave comments in the comments section. Again, if you guys have any friends or people that trade, maybe they're struggling, maybe they're elite, right? Maybe they're really good. If you think that they'll find value or provide value to the community that we are building here, it'd be much appreciated if you share this content with them. Definitely want to get around more people that share the same love and appreciation for this industry, and even those that can provide value to the community as well. On top of the things that we already go over and the things that we do, and maybe they have a different perspective that we can, have a conversation about. I'm always open to, talking with others that maybe don't share the same view on the market. There's always something that we can learn from one another, even if it doesn't change my process or, vice versa. Maybe it doesn't change theirs either. There's always still something that you can gain from experiences, perspective. But the last thing we want to do at all is attack others for the way they trade, right? But yeah, if you guys have any friends that you think would enjoy this type of content, that maybe would enjoy hanging out with us, or you think that could, maybe come and also provide value, different perspectives maybe, definitely show them the channel, let them know. If you haven't subscribed to the channel, you get a lot of value from here, from what we share here. Definitely consider doing that. Greatly appreciate the time you guys spend, because again, there's everybody on YouTube and all these other people that have bigger followings. You guys have decided to spend 2 hours with me, and I can't express how grateful I am to continuously have that. Um, so yeah, I'm glad to hear your guys' progression. Tony, keep smashing it, right? Keep looking at others do foolish things and just keep doing the right things. And I'm telling you, it'll all fall into place. And I'm sure at this moment, with the things that you've seen the last couple of weeks, the things that you've learned from ICT, I'm sure you see that it's 100% possible for you. It doesn't have to be overly complicated. And, you know, there's a way to make this repetitive and very understandable. So in the Nutty Fafa too, I appreciate you as well. Definitely let me know if you have any questions also. You also continue to grow. I appreciate hearing about your story as well, your improvements and the adjustments you've made. Again, dude, you're really young. We had this conversation before. You're super young, bro. You got nothing but time. So be patient. Just continue to show up and take the things that you think are going to be impactful to you that can improve any other things that you feel need improvement in your trading, and just keep pressing forward, bro. Again, you're super young. Anyone that's super young and watches the content, you're lucky. I started trading when I was 25, 26. I'm 30 now. Okay? So it's been a journey, and I wish I was 18 when I learned this. It would have saved me a lot of chaos in my younger life, right? So, but yeah, guys, we will put a ribbon on it as long as everything made sense. You guys told me that it all made sense. I'm going to use girlfriend IG. Okay, yeah, perfect. Definitely do that, Tony. WMG Trading on Instagram, and yeah, we can definitely dive into conversations there as well. Or again, we go live every week, so I'll see y'all next week as well. I might do a call. Well, in February we're gonna start doing multiple calls a week, probably 2 or 3, aside from the Sunday calls. And then of course I gotta spend some time with my private community as well, make sure they're taken care of. But yeah, we have a lot of things to do this year. We have a lot to go over, a lot of progress to make, and hopefully by the grace of God we'll have a lot of lives to impact, right? And it starts with you guys. Okay, so yeah, again, thank you guys for hopping on. If you guys have any friends that you think would benefit from this, definitely let them know. Send them a link, video, whatever it may be. Definitely want to see the community grow, and because that means we impact more people, and I know how powerful this stuff is. So yeah, thank you guys for hopping on. Let me know if you guys have any questions. God bless you guys, and I'll see y'all next week.